Top three things that individual investors should be focusing on before they make their investment decisions. And as I said off the top of the show, very well received part of our show. I get questions on this all the time, asking just exactly how I come up with these ideas and why they are top of mind, or why they should be top of mind before individual investors make their investment decisions. So what do we have for our show this week? Number one, key U.S. bank earnings. We've already received a number of bank earnings. I think very, very important to give us an indication how the U.S. economy is faring. Obviously, with the U.S. government being shut down, I think bank earnings give us a pretty good glimpse as to how the economy is faring. Number two, despite U.S. government shutdown, the CPI data. This is an inflation measurement. Inflation measure is going to come out Friday, October the 24th. That is next Friday. So yes, the government did come back or is coming back long enough or for enough time to gather this information on inflation. And it's going to be a key and perhaps a market mover. We're going to receive data that will tell us, is inflation still at that 3% rate? Has it gone higher? Has it come down a little bit? This will be a key measurement for the Fed to decide if they're going to continue to cut rates and how quickly they will cut rates. Will they cut a quarter point more, or will they cut maybe 50 basis points, 1/4 point cut at each of the next two meetings before the end of the year? Maintain reasonable expectations. This to me is extremely important because I think expectations have gotten a little bit out of whack for certain investors. Making 10, 15% just isn't good enough anymore. We've seen the markets gaining so much over the last, let's call it 6, 7 months, coming off their lows and now at basically all-time highs, that I think individual investors have been sort of, getting used to it. And when you come in with more normalized returns, normalized from the standpoint of historical values, individual investors are just kind of yawning or saying, well, that's all we can make at this point. So we just got to be careful about our expectations. So let's move to our first topic, which is key U.S. bank earnings. And we can move to our first chart, and that's one of JPMorgan. And you can see JPMorgan has had a phenomenal run, an unbelievable run. The actual stock is closing in on a $1 trillion market cap. Yes, it would be the first bank in North America. Obviously, JPMorgan is the largest bank in North America, one of the largest banks in the world. First bank in North America to reach $1 trillion in market cap. Still have a little ways to go, but it's been on a great run. And why not? We just received numbers from JPMorgan the other day, and they were phenomenal, unbelievable in every respect, And net interest margin, maybe a little bit weak. What net interest margin is the gap between what they pay for, GICs, or what they would call in the US CDs, to term deposits, what they would pay when you leave money at the bank versus what they charge you when you take out a loan. So it's the difference between what they charge and what they make. Net interest margin was a little bit disappointing, but other than that, everything from trading to wealth management to they call it FIC trading, which is the all types of trading, fixed income, commodities, everything was great. We saw the IPO market doing extremely well, probably the best IPO market we've seen in the United States really in many years. Again, a name like JPMorgan benefits from that. It's just been a great run. Loans, again, no matter what you looked at, right across the board, JPMorgan, they beat on the expectation. The stock actually fell a little bit because heading into the number, they were up something like 28% for the year. So very difficult. They had a high bar to beat. They beat on top and bottom, but I guess the market was taking it in stride. And when they released their earnings, the market actually sold off the stock a little bit. But I think that will rebound and the stock will be just fine. Next stock that we have is Bank of America. Again, Bank of America, another big bank stock. Earnings are good. Everything is solid, taking in a lot of money into their savings accounts. We often hear from Bank of America, they're a pretty good indicator as to how the consumer is faring. They have a unit of Bank of America that studies the consumer. And even though they may not be spending as much, So they have told us that recently. They're still saying the consumer is extremely strong. So Bank of America, just like the other banks, has done extremely well, fallen off a little bit. You can see on the right-hand side of that chart, but still sitting just under $50 a share. Goldman Sachs, our next chart, again, phenomenal earnings. They make a lot of money on trading, a lot of money on trading and investment banking. That is where Goldman excels. And they definitely excel this go round. They had a bit of an issue with respect to expenses. Expenses were a little bit higher this quarter than anticipated, but make no mistake, another phenomenal quarter for Goldman Sachs. And our last chart here is Citigroup, and Citigroup now again right across every sector of their business, every part of their business is doing well. All the international markets doing well. It was just a blowout quarter, and the stock on the day they reported actually was one of the best performers of the U.S. banks. They reported at the same time as Goldman, as JPMorgan, as Wells Fargo. Wells Fargo also had a great earnings report. We don't have that chart for our show today, but Wells Fargo, like Citigroup, had a great day on the day that they reported. So what does that tell us for the stock market or the economy? I think it says the economy is doing just fine in the United States. I think the economy is doing well. I think the consumer is doing well. We keep hearing that Bank of America, from Bank of America and other banks, that the consumer is still spending. JPMorgan CEO Jamie Dimon has said recently that he's concerned that things may slow, but he always takes a bit of a cautious tone. And maybe that's also why the stock of JPMorgan was down earlier this week when they reported. But make no mistake about it, if the U.S. banks are telling us anything, they're telling us that the U.S. economy continues to be strong, and these U.S. bank stocks continue to climb. And for the most part, they're starting to get a little bit pricey. But I think you can still pick a couple of those names, like a Citibank that's only trading at 1x book value. So book value is basically the bottom price. If you were to strip out everything of the bank, what would the bank be worth? That is what their book value is. And they're trading just above that. So still not getting a premium for a fantastic business over at Citibank. Our second topic that individual investors need to be focused on before you make your investment decisions is the inflation data that this is what we're told, is going to come out next Friday. There obviously are no guarantees, but if it does come out, it will definitely, well, it can be a market mover. If it comes out basically in line with where the other numbers have come out most recently, then it may not have much of an effect. And what are those numbers? Our first chart will show us. In the US right now, you're looking at a CPI rate, core rate of about 3.1%. The headline number is just under 3%. If you were to look at PCE, another indication of inflation for the Fed, personal consumptions and expenditures, you're seeing that's coming in at around 2.7. So I think it's safe to say right now that the inflation rate in the United States is in at around 3%, far away from that 2% that the Fed would like to see. And again, we'll see what this CPI data looks like come next Friday. I thought it'd be interesting to show our next chart because that actually will show what the Canadian rate is. If everybody or some of you may have forgotten, the Canadian key interest rate, inflation rate, we can show that, our next chart. Bank of Canada's rate, there it is. You can see our Bank of Canada rate, 2.5%, and the inflation rate, 1.9%, which is, I think, still gives us room, gives the Bank of Canada room to cut rates, and I think they should cut rates. Make no mistake about it. I've said this a number of times. I think the Bank of Canada should cut maybe even 2 more times before the end of this year. So hopefully they're listening, and hopefully they'll agree with me. Stimulate our economy. We need to get rates as low as we can, and cutting taxes wouldn't hurt either, as I've said many times. So CPI on Friday, not this Friday, but next Friday will be key for individual investors. Our last point that I wanted to talk about before you make your investment decisions is really being grounded in your expectations. We need to keep reasonable expectations. I think in some ways expectations have kind of got out of whack a little bit skewed to the upside. And why not, right? We've seen tremendous gains this year and even over the last few years. And I thought it'd be interesting to see exactly where we sit with respect to how things have been recently versus the averages. What is the average for the TSX and for the S&P 500, and how do we compare over the last few years? Our first chart actually shows what direction the stock market will be over the next 6 months. It basically gauges, a direction for individual investors, whether they're bullish, whether they're bearish, or whether they're neutral. You can see the gray is neutral, the green is bullish, and the red is bearish. Numbers don't really change an awful lot. They are moving a bit to the upside on the bearish side and maybe slightly to the downside, to the bullish side, to the upside on the bullish side, and slightly downward on the bearish side. Neutral kind of stays roughly where it's at. So it looks like people are getting more bullish, which is maybe for those contrarians out there, maybe it could be a contrarian indicator, and some may be selling into this bullish sentiment. Our next chart here shows exactly what I was referring to. The S&P TSX. So the TSX total returns. What is the average for the TSX over the last, let's call it 1948 to 2020? You're looking at 70 years or so. What is the average? And for the TSX, that average comes in somewhere around 7-ish%, 7.5, maybe 8%. You could see here the middle graph, the middle bar there is the 0 to 10%. You can see that is the highest that it goes to, and most years it falls within that 0 to 10. On either side of it is slightly below, but overall you could see that the TSX averages somewhere around 7%. Well, I can tell you this year the TSX is over 20%. Last year it didn't make as much, but still above average. So we've been getting above average returns on the TSX, and that probably is one of the main reasons why expectations have been so high. Let's move on to the S&P 500. The S&P 500, there it is. What is the average for the S&P 500? Well, you could say it's somewhere around 10%, plus or minus a little. And again, that large bar, if you will, which is cut up into all the different years, that is the 10 to 20% mark. And I would say it's probably closer to 10% than it is 20. That has been the average for many, many years. In fact, I believe when I first started in this industry about 26 years ago, average was probably closer to 8% than 10%, but it has definitely moved higher to 10% recently. And over the last 3 years, I would say the average has probably been closer to 20%. The averages have basically doubled, or the average for the previous 70 years. The last 3 years has been 20% on average for the markets, maybe a little less, maybe 17, 18, but in and around that area. And this is why individual investors, I believe, their expectations are starting to get a little bit to the upside, skewed to the upside. And I think that if we can still maintain that 8 to 10% rate of return on an annual basis, that is what we're striving for. That means you're going to double your money every 7 to 8 years, 7 to 10 years. And that should be what everyone is looking for. Our last chart here shows a nice comparison between the S&P 500 and the TSX. And you can see, yes, the S&P has outperformed, but not by a lot over the last, I think this is a 5-year view. It's only outperformed by less than 10%. So even though the S&P 500 has outperformed recently, if you go back over a period, I guess that would take us to 2020 COVID times or just slightly before, the S&P and TSX haven't deviated an awful lot. So main message for me is not so much to you want to make obviously as much money as we can, but you need to have the right expectation. We can't be greedy. We need to take our wins when we have them, trim those profits, move money around, take a winner, perhaps take some profit off the table. Don't just let it all ride. I don't think that is a great strategy. It's not prudent, and it's not the strategy that I would use. Take some money off the table, move that money around into other areas. And I think that is what individual investors should be doing, letting it all ride and taking a chance that perhaps a certain investment might pull back. That is a bit on the higher risk side, and definitely not a strategy that I think many investors will follow. So overall, I think you want to keep the right expectations in mind, keep an eye on inflation, and let's look at or continue to look at key bank earnings. We're still going to get a few more bank earnings that are coming out, and let's not forget Canadian bank earnings will be coming out next month as well. So if you can keep an eye on those three things, I think that will go a long way as you continue to build out your investment portfolio over the short and long term.